Hi, everyone. I think we're just going to get this started now. Wanted to welcome everybody to our first Insights webinar. We've had some clients, some family, other advisors in the industry come to us and ask us to do an update. So we decided that going forward, we're going to do an update probably about a month after we do the Insights. We felt it was very important now to do one. So this is our first go around at doing a webinar. So please be patient with us. It's a bit of a learning experience, but we think we've got a good handle on it. So for those who don't know me, my name is Sergio. I'm an AIF. I am the founder and CIO of Banyan Wealth. I am also a financial advisor and registered principal with Raymond James. So our four disciplines of investing. Investing is a marathon. It's not a sprint. Do no harm. Knowledge creates success. Stay calm, objective, long-term oriented. Choose carefully what you read and to whom you listen. So the S&P 500 posted its worst first half of the year since 1970. It was the largest loss of wealth in the first half of the year in over 3 decades. The Dow Jones Industrial Average dropped 15%. It's a 30 stock index. The S&P 500 dropped almost 21%. The NASDAQ first half was down almost 30% for the first 6 months of the year. And the Bloomberg U.S. Aggregate Bond Index, which is an intermediate, high-quality bond index, roughly around 10 years in duration, dropped over 10% for the first 6 months of the year. So it's been a challenging market environment. Markets, for the most part, became decoupled. The inverse relationship between fixed income and equities became broken. Fixed income investments fell nearly as much as equities. The 20-year government bond index, which is your ETF for 20-year government bonds, dropped almost 25% at one point. So basically, most asset classes became correlated that are generally not correlated. The S&P fell over 24% from January 4th through June 20th. So what basically happened is that fixed income and equities tend to react in opposite directions, like a seesaw. And what happens when inflation, and equities are a good hedge for inflation, comes into play, equities tend to rise and fixed income prices go down and yields go higher, and vice versa. When the economy really slows down, equities go lower and fixed income prices go higher in a search for quality. What happened in the first half of 2022 is that relationship became decoupled and the seesaw broke, as per our illustration here. Bonds went down, equities went down. And what really drove that? What happened? Well, the Russia-Ukraine conflict began January 24th, 2022. An energy and food crisis also began taking inflation to new levels. The CPI index, which is basically your gauge on inflation, the May CPI rose 8.6%, and the June CPI rose 9.1%. Now, generally, when these conflicts happen, markets generally bottom somewhere before, sometime during, shortly after. They tend not to extend for a longer period of time. That has not been the case with this conflict. And what's happened is that interest rate policy by the Federal Reserve in other countries changed courses from gradual measured increases to a more rapid, uncertain path of much higher rates and an urgency to get there quickly. Financial markets do not like uncertainty. They like certainty. They have to value risk assets. When the policy of the United States and the Federal Reserve changed to a more rapid policy, a policy of 50, 75, 100 basis points, it threw a massive amount of uncertainty into the investment profile, which rippled through fixed income and equities and other asset classes. So here is a chart of the CPI index. The blue line is the CPI index, and you can see that the increase Well, the increase for the CPI started really, was moving up slowly, and then just exploded from February through the end of June. And it was a broad-based increase from gasoline, shelter, food being very large contributors, but energy contributed nearly half of the items increase. Food and shelter were the next two largest increases. So as we look at this chart here, this is gasoline, the yellow line. And you can see that this is during the COVID time period. Oil went to negative at one point. Gasoline was extremely depressed. People were home. No one was working. We were in lockdown mode, and there wasn't much going on. As the economy started to open up in 21, you see gasoline start to spike up. Bigger demand from a zero demand to a big demand really quickly as people started to go outside and return back to some normal behavior. Gasoline pulled back. As more of the economy opened up, it went back higher and then started to ease back down towards the end of 22, right before the crisis or the conflict began with Russia and Ukraine, and then rapidly exploded up right after the beginning of that crisis. If you look at grocery prices, food inflation, you're all feeling it at the grocery store. We're feeling it. You look at baked products, Russia and Ukraine, bakery products, I'm sorry. Russia and Ukraine are a big supplier of grains to the markets. And once the conflict started, you see these bakery products surge in price. That's the grains market, ripping up higher in prices, driving that price right to the consumer and driving up inflation. And the same thing with the margarine, the butters, the processed foods. Those prices went up as a result of the conflict. Housing prices. I bring up housing prices because housing prices is really a COVID issue. During COVID, construction stopped, supply chain stopped, a lot of the world stopped moving. And as we started to reopen and started to build projects and take stuff that was off the shelf, that was shelved during COVID, and bring it back and put it online and start multifamily construction and new home construction in order to meet demand, you saw a big price increase in commodities that feed into the building market. So whether you rent your primary residence or you have rentals, a short rental, multifamily rental, you've seen increases in rent across the board go higher. So let's take a look at, inflation and energy. This chart is a chart of WTI, which is West Texas Intermediate. It's our oil that we produce here. All these charts are from July 31st to end of the month. So things have changed quite a bit. For the good side, they've actually most of them have gone lower from here. But this is a chart of WTI. WTI in February was roughly around $85, $90, give or take. The conflict began, ripped up to $120 plus, pulled back, and ironically peaked right around the June CPI print. Since then, WTI has come down materially, and I think today it's in the low 90s from a 125 high. Natural gas is down 14% from its June high. Natural gas, you could see in February, spiked up with the conflict, pulled back, and was doing okay until Russia decided they wanted to mess with Germany and other countries in terms of their gas supplies on Nord 1. And that really pushed that commodity up substantially. It again peaked right around the CPI print in June, pulled back meaningfully, and now pushed back up due to a really warm streak going across the country and Russia tuning down some gas supply. It's pulled back from here. It's lower than this $8 number. The U.S. is shipping a lot of LNG overseas to Germany, and it's been really hot here. So we do think this is going to ease back down in price, but this feeds through your utility bill, your electric bill, and through other inflationary vehicles. So hard red wheat. This is used in a lot of baked goods, a lot of breads, bagels, pizzas, all that sort of stuff. Hard red wheat was roughly around $8 pre-crisis, ripped all the way up to $14. That's a massive increase for the consumer. And now is pulled back down to $9. It is lower from here currently today. And we look at lumber. And the reason why I bring lumber in here is it drives the cost of shelter, housing, affordability housing. The higher lumber is, the more expensive a home is, the more expensive a rental is for a multifamily. It just feeds through everything. And I also bring this up to illustrate a point. is that last year and towards the end of last year, all we heard about was lumber, lumber, lumber. The media was constantly talking about lumber prices going through the ceiling. And yes, they did. But when we look at futures contracts to see where commodities are going, there's something called the futures contract. There's the front end, which is the closest to today, and then there's the back end, which is out a year, 2, 3, 4 years. When the front end spikes, it's a combination of a bunch of things, which I'm going to elaborate on in a little bit, but it's a combination of a bunch of things. When you go out farther in the curve, that's where the distributors, the end users, the manufacturers, that's who's buying that. That is the smart money actually buying, hedging their products or trying to secure products to the futures market. The front end of the market is driven by a different animal, and I'm going to explain that in a little bit. But we look at lumber, and we were looking at the futures contract, and lumber was very expensive, and we were saying this is going to come back to $500. It's coming back down. The smart money's telling you 6-9 months from now this is a lot cheaper, and sure enough, lumber's sub 600. So as I talk about lumber, food and all that stuff, I know a lot of you are saying, hey, Nick, I really don't care what lumber's doing. I'm not a builder, or, I don't really care about natty gas. What I really care about is when I go to work, it costs me $1 zillion to fill up my truck. Well, the good thing is that gasoline has dropped substantially in the futures market as well as in the consumer market. RBOB, which is blended gasoline on the futures market, is down 27% from its high. So let's take a look at this next slide. Gasoline peaked out, again, right around the CPI number at $5.02 on June 14th. The natural average today is $4.22. This was as of the end of July. I'm going to give you some updated numbers in a sec. Summer driving is coming to a head at the end of the month. And we've already seen a 21% drop in WTI oil, which feeds right into gasoline. Gasoline's a product of oil that we make here. And it appears to have more room to drop. Regular gasoline, unleaded gasoline a year ago was $3.17. It was $1 higher. Looking at the numbers today, as of yesterday, the national average for gasoline is now $4.03. It's down 98 cents from its high. It's 20% lower today. Regular unleaded gasoline was still higher. We're still higher, about 26% from a year ago. But based upon where we're looking at futures contracts and what's going on in that market, it looks like regular gasoline could go into 350, 375 range for national average. And that's a lot better than $5 a gallon. And diesel is dropping as well also. Crude inventories are rising. Crude production is rising. Gasoline inventories are rising, and gas demand is dropping. So you're starting to see a little demand destruction with the higher gasoline. But the good thing is that the consumer that's going out, going to work, taking their kids to school is going to see gasoline cheaper. And that's a good thing for your pocket. It's an extra 20, 30, 40, 50 bucks every time you fill up. It makes a difference to most people out there. So this is something that I really wanted to talk about. And we haven't heard much about it as well. So these are base metals. These base metals are in a lot of what we use today, whether we're building or whatever. I'm going to go into some details. Base metals have collapsed in price. These are all leading economic indicators, from oil to grains to lumber. They're all leading economic indicators. So these leading economic indicators take time to reflect into the inflationary data, as well as filter into the consumer. Gas doesn't drop $1 in a week, and you see it at the gas pump the next day. It goes up an elevator, it comes down like a feather, someone said. So it takes time to filter into the consumer for the consumer to feel it. But this is a very important slide, and you're not hearing much about it because it really doesn't, a lot of people really don't pay attention to it. Copper, which is used in a ton of industrial products, building, pipes, you name it, wiring, electrical, has dropped in the last 3 months 21%. Year to date, it's down 20%. Nickel, if you have a Tesla, an electric vehicle, a cell phone, which we all have, any kind of battery-driven device, nickel is in there. In fact, yesterday, Tesla signed a $6 billion deal, $6 billion to secure nickel for its electric cars. Nickel has dropped 32% in the last 3 months. It's down, it's only up 5% for the year. So very little inflation there. Tin has dropped 40%. Aluminum has dropped 20%. These are all deflationary items. They're forward-looking leading items. And they should have a follow-through into the consumer, into the consumer's pocket, and take some of the inflationary pressure that the Federal Reserve is so concerned about, and that has put the markets in a high anxiety state. So what the Fed does look at is the Fed tends to look at lagging economic indicators. So I kind of say, looking at the leading economic indicators that we had just looked at, that's kind of like driving down the turnpike or the Garden State Parkway or any major highway. You got your hands on the wheel and you're looking straight ahead. You see the potholes, you see the cars weaving in and out, you see the danger ahead. That's what leading economic indicators do. Lagging economic indicators are similar to driving down that same highway, but you're looking in your rear view mirror. You're looking back. The Fed is looking at older data. This data leading economic indicators will feed into data in the future, while the Fed is looking at data that's already peaked, in our opinion. And the CPI index is one that they spend a lot of time looking at. Core CPI, which excludes food and energy. So the Fed really, initial focus was on core, excluding food and energy. And then we saw the spike in energy, and then the Fed said, well, we got to work on energy now. And their method, and their single method, is basically raising interest rates to kill demand. They want to kill demand. So we're seeing some of that demand in those leading economic indicators already starting to come down substantially. And we're seeing those prices come down substantially. So the Fed is looking at lagging economic indicators. So here's a very interesting chart by JP Morgan. Has inflation peaked? Well, if you look at this chart, you'll see that that JP Morgan believes that inflation peaked and that inflation is going to materially come lower in 2023, somewhere to the tune of 2% range is where they're kind of modeling out. Based upon some of those leading economic indicators, I think inflation does come down. And if inflation starts to come down and starts to drop 5, 4, 3, and starts that ascent down, that ski slope down, I think you see the Fed maybe back off of their really hawkish interest rate hikes. And that will be good for risk assets. It will be good for fixed income. It should be good, I should say. It should be good for fixed income. It should be good for risk assets in general. Less urgency to raise interest rates, lower inflation will be good for investors and good for everyone's pocket and the future of net worth. So taking a look and saying, the big question is, are we in a recession? And this is not the Rutgers R, if anybody went to Rutgers, wink, wink. 70% of Americans think a recession is coming. So it's irrelevant whether we're in a recession or not. 70% of Americans already have it in their mind, and they change their spending habits. Once they think we're headed to a recession, you think you're headed to a recession, start to tighten that belt up. So yes, the technical definition of recession is 2 consecutive quarters of negative GDP growth. Well, quarter one, we had a negative 1.6. Quarter two, we had a negative 0.9. And very, very quickly, Treasury Secretary Yellen and the Biden administration were out there to downplay a recession because there's a midterm election coming, only a few months away. So looking at some recessionary indicators, looking at this as a yield curve of the 3-month Treasury and the 10-year Treasury, it's basically the 2 yields. And what we do is we look at the spread between the two of them. And we believe This is one of the most important indicators that the Federal Reserve does look at. And the spread was pretty wide in May. It was about 230 basis points. And it's come down to about 26 to 35 basis points. Usually when that curve inverts, it's a pretty good sign that we're either in a recession or headed towards a recession. But yet this curve has still not inverted, but it's getting pretty close to inverting. So the real question is a recession the wrong question, right? Because it doesn't feel like a recession out there. It doesn't feel like we're headed towards a recession. So the picture here is of a gentleman called Neil Kashkari. As you can see, Neil and I share the same barber, and he does a great job. And Neil is the president of the Federal Reserve Bank of Minneapolis. He was recently on Face the Nation on Sunday, July 31st, to provide some insights. And he basically said, we're going to do everything to avoid a recession, but we are committed to bringing inflation down. We are going to do what we need to do. Then he said, whether we are technically in a recession or not doesn't change my analysis. Solving the problem by reducing inflation is the Federal Reserve's top goal right now. Well, I think what they're looking at right now, part of the reason, well, I should backtrack. So Neil Kashkari, nickname is the $700 billion man. For those who lived through the great financial crisis, Neil Kashkari worked with Hank Paulson, and he was the head of the Office of Financial Stability during the GFC. Neil Kashkari basically and Hank Paulson designed the bailout package for the great financial crisis, TARP, TALF, and all that stuff. And they're the ones that built, designed, funded the markets back in 2008, 2009, when the markets were in that big they were in big trouble at that point in time. In fact, Neil is responsible for the playbook that we used in 2020 with COVID. We took that playbook that these guys designed, and we backstopped the economy, we backstopped the markets, and that's what led to a very shallow recession. So thinking about whether we're in a recession or not, in 2008, 2009, during a great financial crisis, we saw the S&P drop 40+%, the NASDAQ 50%. We had massive leverage out there. You had Bear Stearns, you had Lehman, leveraged 25, 30 to 1. You had household consumers leveraged. You had low savings rate. You had household debt to income extremely high. You had you had a credit crisis, and that's why that recession was so extremely deep. I don't believe we are in a credit crisis. When you look at household debt, service payments, disposable income, those ratios are nowhere near where they were in 2007, 2008, 2009, during that financial crisis or recession. They're nowhere near 2001. There's $18 trillion of cash deposits in commercial banks. That is a lot of money. We didn't have that back then. And whoever heard of a recession that's got a 3.5% unemployment rate? The unemployment is lower than it was pre-COVID. Despite what everyone said during COVID, during that crisis, employment will never get back below 6, never get back below 7. It's lower now than pre-COVID. And I'm a big fan of wage inflation, but we have such strong growth. The non-farm payrolls were so good last month that we had 11% wage inflation. And that's something the Fed is looking at. They are actually looking at trying to create some unemployment and take the pressure off of wages, because 11% wage inflation is a very, very strong number. But I think we're probably in an economy or fight against inflation that's similar to Volcker and similar to Greenspan. Back in Volcker, back in the early 80s, Greenspan in the early 90s, where we had a mild recession, but it wasn't a credit recession. It wasn't a deep recession like 07, 08, 09, or 01, 02. It was a recession that was a fight against inflation by raising interest rates. And once they got the inflation issue under control and they got everything to those pressures to come back in, the markets overall, fixed income and equities, per- performed fairly well. So I think we're more in a fight against inflation than in a credit recession. But there's something I wanted to touch on before I'm going to backtrack just a second. I want to talk about the commodities picture for a second. We saw commodities make explosive moves higher in price, right? And I touched briefly on the front end of the curve and the back end of the curve. And that just means the rate of price. The front end is closed and back end. So think about what we talked about: gasoline, $3 to $5, wheat, $4 to $8, natural gas, oil, $85, $90 to $125. There was an article in the Wall Street Journal this weekend. I read the paper. I'm a Wall Street Journal junkie. I think it's a great paper. There was an article this weekend: speculators ditch commodities. Hedge funds, institutions, and speculators were in that market to a very large extent. In the grains market, where you're seeing your food inflation today, and we saw hard red wheat go up, we saw corn go up, soy go up, all these commodities that went up in the short end that have all come back meaningfully. There was $57 billion. I'm going to say that twice. There was $57 billion poured into the grains market, commodity exchange, in those futures, in new speculative bets in the month of March alone. It was the biggest influx of cash into a commodity in 11 years. So some of that price that you saw in those grains and in those commodities were not driven by fundamentals. They were driven by speculation on prices moving higher. When you have that much massive money flowing into commodities, you are going to get these spikes. And what happens as investors when you make or look to make decisions based upon short-term fluctuations, sometimes prices are moving for all the wrong reasons, not the right reasons. And you could easily get shaken out of investments due to, speculators in a market that think something's going materially higher, as in the case of the grains markets. So rule of thumb is, markets sometimes disconnect from business cycles. They're driven by speculation. They're driven by fear. They're driven by greed. And so you look at the investor sentiment, and this is an excellent chart by Raymond James. It's about a month old or so. It's basically the investment sentiment. Markets are driven by fear and greed and loosely connected by the business cycle. And that's what you saw in those commodity markets. And that's why I bring that up. This chart has us in the fear panic kind of range. I think we've blown past that. I think we're probably more in the despondency phase right here. And I think we're looking at possibly a better second half into next year. I think people are kind of, just upset with a lot of things, the world, you have Russia, Ukraine, you have bombings, you see nothing about, all you see is about food crises, war, high inflation. I mean, it's just a beat down of negativity. And, there's an old expression, misery loves company. And that's why newspapers sell and media, is around. So I think we're past that stage. I think we're kind of troughing through it. And, I think, investing attitudes will probably change in a meaningful way in the next 6 or 12 months. But yeah, I am, people ask me, what are you concerned about? I'm concerned about a lot of things. The Federal Reserve policy, they can make a mistake. Monetary policy becomes too restrictive, leads to growth, slows the economy substantially, will put us into a severe recession. I got to believe what people like Neil Kashkari, as a Federal Reserve member, these guys have been through this rodeo before, so they're not rookies to it. Russia, Ukraine could escalate, could go global. I don't know, but you can't invest around that because there's always a conflict somewhere. Lack of jobless claims continues. Wage inflation becomes entrenched. I think the Fed's going to try to put that gas pedal down on that and try to, slow that down meaningfully. Shelter costs continue to increase. Mortgage rates go up, housing prices go up, rents go up, affordability goes down. It takes the average person more weeks of work in order to get a down payment. It takes the average person more weeks of work or more days of work in order to make payments. So I'm concerned there, but if inflation does tend to roll over and lumber and those base metals and stuff, housing should become a little bit more affordable. And if the Fed takes its gas pedal off interest rates somewhere in the next 6 months or so, you could see mortgage rates come in. So, I'm okay there as well. With China's zero COVID policy, I don't agree with it, but they're back open. Supply chains are getting much better. Baltic Sea rates, which is your shipping rates, are back to pre-COVID levels. So supply chains are opening up, and I could go on and on that one. And the U.S. dollar's been very strong, hurts multinational earnings, but it has weakened recently. So I am concerned about some of these things. So key takeaway in summary is, inflation may have peaked. Commodity prices appear to be rolling over. These should be a good thing for both equities and fixed income markets. It'll take some time to filter through. It's not going to be tomorrow, but it'll take some time. But I think a lot of these base metals and commodities are headed certainly in the right direction, certainly gasoline and fuel. And maybe the markets have bottomed in Q2. A lot of analysts are looking for that big blow off bottom, that high price and printed volatility. The volatility index, I'm getting a little into the weeds here, had a similar reading that it's seen in other mild recessions. Maybe the Fed was so telegraphed that, it was a bottoming process and not just a capitulatory blow off bottom. I'm not, my kind of feeling is that we probably bottomed, but we'll see. I skied as a kid, and I'll I say this to clients quite a bit. We have quite a few clients that are retired and they were ski instructors, part-time as they ran their businesses and stuff. And I say, you don't ski looking at your ski tips because you're going to crash. You don't invest day by day, week by week. You look down the mountain, not at your ski tips. So investing is a longer term thing. It's an intermediate to longer term outlook. What things do on a day-to-day basis is anybody's guess. But I'm going to open it up. I know I've went way over. I know it's summer. I don't want to keep people at their computers for too long. So I'm going to open it up and see if we have any Q&A. If we don't have any Q&A, JR, how are we looking? We're looking all right?
Yeah, we had one question come in during the course of the webinar about the commodities and the moves in commodities up and down. But I think you covered that. So unless there's any other questions.
No, I think that was, part of it was, end users were looking to secure their product. They were concerned, especially companies that make baked goods. But I would say a bunch of it was speculation in the markets. So I'm going to conclude this 1 second before you jump off. And I just want to say a couple of things. If your advisor's in the New York office and you have any questions, give them a call. If your advisor's down in the Toms River office, give them a call as well. If you have any questions or concerns, and you want to follow up on this, and you're based out of our team here in the Red Bank office, send us an email, give us a call. We'll set up a call with you, and hopefully we can walk you through whatever questions or concerns you might have. If you're a prospect or someone new to the Raymond James Banyan Wealth, you go on our website, send us an email, give us a call. We'll set up a meeting, a call, and we'll help you out as much as we can. But I want to thank everyone that entrusts us with one of their most important assets, their financial assets. I want to thank them for their confidence in us. We're working hard for you guys, and I appreciate your time on a Tuesday night during the end of the summer. Enjoy the rest of your summer. For those that want to see the disclosures, there are disclosures at the back of this webinar. This webinar will be posted on our website probably within the next several days or so. Certainly, hopefully no later than early next week, it will be posted. I appreciate everybody's time, and enjoy the rest of your summer. Be safe, be well, and live life to the fullest. Thank you very much.